Hello and welcome back to your South King County Real Estate Update. My name is Sarah Eggleston with Stone Egg Realty at John L. Scott, and I'm back to deliver your local real estate news for South King County. Today is April 22nd, and let's jump into those slides. So we have our South King County Real Estate Update for April 22nd. Just a reminder before I jump into things that I do have my Seahawks, my Mariners schedules in. They're ready to go and they are shipping out tomorrow. Let me know if you want one as soon as possible. I mean, if you don't make it by tomorrow, I'm happy to send one whenever, as long as I have extras. But at this point, I have plenty of extras. So if you want one, please let me know how I can get it to you. And what happened this week? This is actually a little bit higher perspective than one individual, but one of those things that has happened this week is the interest rates. Interest rates have gone up. I have seen a significant decrease in buyer activity in general. Overall, really, like my clients, other people's clients, we've had discussions about how we've had several people dip out of the market because they no longer qualify for what they once did. And with the home prices going up, it's one of those things where you have to really analyze your situation. Did you refinance recently? Are you comfortable in your home? If you're a first-time home buyer, what's your rent look like? Rents are headed up incredibly quick. So if you are able to purchase a home and are unsure as to whether you want to accept that mortgage rate, but you're comfortable with that payment, my recommendation is just go with it. If you're comfortable with the payment, move forward. And if interest rates continue to go up, that means rent is going to continue to go up as well, because the cost of owning a home is generally passed on to the tenant. So if the cost of owning a home goes up for the owner and they're renting it out, the cost goes up for the tenant as well to cover that difference in, maintenance costs have gone up, taxes have gone up, everything. So just if the cost of home ownership generally goes up, then rent goes up with it as well. And we have seen rent increasing at a greater rate than home prices. Honestly, there's been so much change in the rental market recently that is just mind-blowing to look at. Whether you're a landlord or a tenant, seeing those, obviously you're going to have different reactions to seeing the rent prices go up, but it is kind of shocking how fast it's increasing at this point. So if interest rates go up, you are locked into your current rate if you purchase a home. If interest rates go down from the time you purchase a home, you can refinance and take advantage of those lower rates. So as long as you're comfortable with the monthly payment headed into the purchase, I totally recommend moving forward. That's just, my 2 cents, my personal advice. But I'll go ahead and jump into the slides for this week since we have so much to cover. All right, so this kind of plays into what I was just saying. 85% of Seattle area renters can't afford to buy. This is unfortunate, but it's something I've said is coming. When rents went down at the beginning of the pandemic, rates went down at the beginning of the pandemic, everything. I encouraged as many people as possible to take advantage of that when it was going on, but we're kind of past that point a little bit now. We have seen a lot of increase in both rent and interest rates at this point, but the rent rates have gone up double digits since last year. This was an analysis by Porch, a home services platform, but 61% of renters nationwide can't afford to buy a home in their city. High rents make it difficult for tenants to save to buy more in the future. One thing that we have here in Washington is the Washington State Bond Program, and this is a program that is meant to help these great tenants who are on time with their rent. They're great tenants, and they just can't save up that down payment to buy. The Washington State Bond Program is a fantastic homebuyer down payment assistance program that we have access to here in Washington. So if the down payment is your biggest hurdle, let's set up a time to chat. I've coached a few people through this, so let's talk. But the average home price in the metro areas has gone up significantly, and that is for home prices and for rent. Financial experts recommend that you spend about 30% of your income on housing. I feel like this is a very, very outdated piece of advice. Yeah, maybe 20 years ago, that was the case. But right now, people are generally spending a little bit more than 30% on housing, whether it be rent or their mortgage. But in the Seattle area, so 61% of people nationwide, but 85% of renters can't afford to buy a home in the Seattle area. The average home is priced at $719,000, and that 36.3% average household rent in the metro area. Renter households in the area have a median home income of $57,500 a year, while the median income needed to buy a home is closer to $104,000. There is quite a gap in equity there. This same report found the average home in the US costs 7 times the national household income, and the ownership is unaffordable for the majority of renters in 71% of metro areas. So this is really unfortunate. And we, like I said, here in Washington, we have the Washington State Bond Program. This is a national article. So obviously that isn't applicable to everybody that's mentioned in this article that can't afford. But if you're in a situation where you're like right on the edge, maybe you can afford the monthly payment, but you don't have the down payment, or if you're right on the edge, it's worth looking into seeing what programs are available in your area. Talk to a lender, talk to a real estate agent. They are fantastic resources to direct you in the right direction for how to, if purchasing a home is not possible right now, how to set yourself up in the next few years to possibly be able to make that change in the future. To help first-time home buyers compete against investors, the Department of Housing and Urban Development recently extended the period during which owner-occupied buyers can bid on foreclosures now owned by the department. As of March 1st, businesses and investors will have to wait 30 days before they can bid on some properties owned by the department. And I have put offers in on HUD-owned properties before. This comment really made me giggle because I'm like, wait, okay, so that'll help a very few amount of people. The amount of HUD properties on the market right now is next to nothing. This article actually prompted me to go and check that out. So I logged into my HUD account and looked for properties that were available in Washington. And there's 3. There's one in Thurston, one in Pierce, and one in Pacific County. So the fact that they even mention this as like, hey, homeowners, you have 30 days now to purchase these before investors can have at them. These properties only come to the market when there is an FHA loan that goes into default and is foreclosed on. That's pretty much when these houses come on the market. And with the home price increases in the nation, really, I was only searched Washington on this, but my theory is that it would be pretty similar in other states. So nationwide, with the home prices increasing so much, people aren't foreclosing. They're just selling because then at least they can take the equity with them that they've gained. Not many foreclosures right now, and that's how these come out, are FHA owned homes that go into foreclosure. So right now in Washington, there are 3 active properties. So I don't really see that as much of a benefit to buyers on the edge in this current environment. From the National Association of Realtors, multi-offer bidding still prevalent despite slowing demand. So as I mentioned before, interest rates have been going up, and that has been sending a downward pressure on demand. Multiple offers has been kind of what we've been dealing with for the last couple of years. Buyer demand has just been insane. Inventory has been incredibly low, so that, a lot of buyers, it's real estate musical chairs. But multiple offers are slowing because of the interest rates rising. There are a lot of cash buyers on the market. So some buyers are finding it hard to compete with these cash buyers, first off, which the interest rates don't affect them. Actually, that's a really important point to drill down on, is we have so many cash buyers in our market that raising the interest rates is not going to have as great of effect as it could if we didn't have all those cash buyers. There's still that demand for the properties. And cash buyers accounted for 28% of sales nationwide. On average, half of the buyers made 2 prior offers before a successful third. I'd say that seems right about on from my experience in this current time period. Nearly 5 offers received per property sold. So that's down from its peak. So we took a little bit of a dip and we're back up, but it's remaining steady there. Demand is weakening, but still outpacing supply. So realtors average said that they took 4.1 clients on a home tour in March and had 1.4 listings. You can see that there's a greater buyer demand than seller supply at this point. And we're down to 17 days on market on a national average, down from 18 days on market. The average number of clients taken on a home tour and listings per month. Listings, you can see is the light blue on the bottom. And that has remained far below our client tours line up top. And we're, 4 times the demand of buyers than sellers. And we are really, really short on inventory. This is something that we just don't have enough homes for everyone. There were 950,000 homes on the market at the end of March. This is nationwide. That's equivalent to a 2-month supply. In our area, we are less than a month's supply, depending on what price point and what area you're looking at. But 6-month supply is kind of what's generally considered to be a balanced market. They say prices are likely to continue, and I completely agree that they'll hold firm for quite a while, unforeseeable future. And the shortfall of 2 million existing homes for sale to meet the 6-month supply. So if we wanted 6-month supply, we would need 2 million additional homes in our nation to satisfy that demand. So another new report came out. New home construction is up, but projects are stalling at a higher rate. So there is more construction happening now. A 13.4% increase from 2020. Builder confidence is tumbling, dropping 2 points this week to 77. For the 4th month, it has declined. There is 47% of projects that are stalled from construction. So either units that didn't start or they have to cease moving forward. Increased 47% from 19 to 21. So this shows how incredibly strong that supply chain jam is. People just can't get the materials that they need to build homes. But home building permits are up 25%. The rise is most notable because of the white hot market we're in. We have seen so many homes go so fast, and I sound like a broken record after 2 years of saying we need more inventory. This is the one I'm really excited to get to: inflation, interest, and the housing shortage. So this is actually an opinion piece from the opinion section on Seattle Times, but I thought this was really well thought out. I just thought this was a fantastic article and wanted to spend a little extra time on this one. A lot of people ask this individual and ask me as well, like, what's going to happen to the market? And I hesitate to answer always because I don't have a crystal ball. I cannot see the future. And there's so many things that affect interest rates and buyer demand, and it's people wanting to move. And human behavior is probably the hardest thing to predict. We know that the Federal Reserve intends to raise interest rates throughout the year. And there has been some people that have said, well, wait, with inflation as crazy as it is, have they waited too long to act? What's going to happen? Shouldn't they just raise the interest rates like crazy to combat this inflation? And no, you have to take these steps very gradually, so you don't shock the market. There's a lot about the monetary policy that goes into how interest rates are set. So the Fed does not directly determine the mortgage rates. We've talked about this before. It's actually tied to the 10-year bond, but banks pay a lot of attention to what the Fed does so that they can prepare themselves for what they expect to see in the future. When they expect interest rates to go up based on what the Fed does, they'll raise interest rates ahead of time, and they don't wait for the Fed to actually raise the rates to raise their daily mortgage or daily rates for their mortgages. They act as soon as they think that the rates are going to go up. Bank rates will start to trend that direction, just so that they can hold on to that money, not do as many loans now, and maybe make more money in the future. There's just so much connected. I mean, our economy is so complex, and any little change can make a bunch of different other things change in the economy. So raising the Fed rate affects the housing market and really everything else. Since 2014, the cost of shelter, as estimated by the Bureau of Labor, has risen considerably faster than the overall cost of living. And this is talking about rental rates for apartments and owner's equivalent rent. The housing bubble and bust of the 2000s, construction just basically stopped. Not completely, but we had overbuilt for so long that we just had too many houses and the demand wasn't there for them. So construction slammed to a halt. And we haven't really picked up the construction again nearly soon enough. Now the buyer demand has passed the amount of homes that we have, and we're struggling to build fast enough, and they're having trouble getting materials, and big struggle. We need higher interest rates, at least for a while, to bring inflation down. But higher rates will work largely by depressing the housing construction, which is already too low. So it's a necessary evil as far as housing is concerned. Like, we don't want to have inflation go crazy and have prices go insane and any more than it already has. But we also don't want construction to stop because we need more housing. Right now, it's basically the best way forward, and there's not really another alternative to fix the inflation rate and conserve the construction rate. It doesn't seem to be able to work together. And that brings us to our market stat minute. So our new listings at 963, pendings at 785, and sold listings at 844 for King County, but we'll drive it home closer to our local area in Renton, Kent. Renton and Kent, we have more new listings than pendings. So that is great for supply. In Auburn and Federal Way, it is the reverse. There's more pendings than new listings. So if you are searching for a home right now, maybe Renton, Kent has a little more supply for the amount of demand that's there. while Auburn and Federal Way may be a little bit more competitive. And I talked about this one last week. I wasn't intending to bring it back this week, but you can see how the Easter weekend affected the showings here, or slowly kind of creeping up along. And it starts to tip down last week for buyer showings in North America. This is partially due to the upcoming Easter holiday, partially due to the interest rate stuff going on. And we plummeted over the weekend, and we are now seeing more showings than we were leading into Easter. So this is a good sign that our buyer demand is remaining resilient to the increased rates. 5% from 4.72. And this week we are at 5.11 from 5% last week. The last time it was higher was in April of 2010 when it was at 5.21. So we are well above where we've been in a long time. US home sales fell in March to the slowest pace in nearly 2 years. So we are back to pre-pandemic demand as far as actual sales. March home prices jumped 15% from a year ago. So we're seeing increased prices and starting to see a little bit of decrease in demand. So that might mean that prices will rise at a slower rate moving forward. I did like this quote from Freddie Mac's chief economist. While springtime is typically the busiest home buying season, the upswing in rates has caused some volatility in demand. It continues to be a seller's market, but buyers who remain interested in purchasing a home may find that competition has moderately softened. And our daily interest rates, you can see they have jumped to 5.39. Our weekly average mortgage rate is definitely a little bit conservative now later in the week. It's jumped up so much in the last couple months. It's crazy. But even in the last week, it's jumped up quite a bit. You can see this little chart here, this little spike at the end. 5.39 was a little bit surprising for me to see today. And just one last reminder, I do have my Mariner schedule. So if you want one of those, let me know how I can get it to you. And if you have any questions, please feel free to reach out. I would love to have a conversation with you about the market in your area or an area that you're possibly interested in. Just reach out. But my phone number and email address are on the screen. You can reach out to me on whatever platform you're watching this video on. I would love to connect with you. And if there's something you'd like to see on this show, any questions you have, let me know. I want to make sure to include information that's valuable to you. So thank you so much for joining me for this week in housing, or your South King County real estate update. My name's Sarah Eggleston with Stone Egg Realty, and I will be back here at 3 p.m. next Friday with your local real estate news. See you then.